Good afternoon. Welcome to today's CareerSwitch lockdown learning session. My name's Joel McInnes. I'm CEO and co-founder here at FlexCareers, one of the CareerSwitch partners, and really looking forward to going through today's session. When I've been going through the research for today to put it together, there is some really interesting insights that I've found. Also a lot I've learnt about some of the stuff I'm going to be talking about. So essentially, what today is all about is a bit of a different style of how to find a job or where to find a job type of session. I'm not going to talk about CVs, I'm not going to talk about LinkedIn profiles, I'm not going to talk about personal brands, all of that kind of stuff. This is very much a top-down approach, and by that I mean if you are sitting, in a helicopter above the economy kind of stuff, what are the signs that things are improving, signs that things are slowing down, and which areas should you be targeting your job search? And just as a bit of admin before we get going, we are recording today's session, so we're going to be making sure to send it around to everyone, and I can see a lot of people still joining, so we've got really good numbers today. I think over 500 of you are expected, so that's really, really good numbers. So yeah, essentially what we're going to be looking at today is the when things are going to start normalising and how to work that out in real time. The where, in the sense of which parts of the economy are going to be opening up first, which sorts of the economy are going to be selling their products back as normal to their consumers. And that, of course, means that which parts of the economy are going to be hiring first, rather than the how, as I said. So this is not about job search, like the actual getting down and dirty type of tricks for finding a job. This is the top-down approach. And essentially, why is this important? We've been having a good discussion around this kind of area for CareerSwitch, because yes, the coaching element is really important in the sense of getting your head in the game, make sure your CV looks really good and all that kind of stuff. But also, what this hopefully lets you do as you face the jobs market, or alternatively, if you are an employer and looking to know when it's okay to hire, because of course we've got both of you, both of those sorts of cohorts on today. Why is it important? It essentially tells you where, so it gives you clues as to what's going on in the underlying economy, and really lets you target your job search, or it gives you clues, again, as an HR person, as a recruiter, as to when it's okay, when it's safe to step back in the water, I suppose. So the agenda for today, a lot of this is all about the macroeconomy, and essentially what I'm going to try to do is this second line there is really all about making that transition between the global macroeconomy, how it affects Australia and New Zealand, and then, of course, how it affects our local jobs market. Shout out to our Kiwi brothers and sisters, and apologies, I'm going to be focusing more on Australia as a market, only because I know that better. Then we're going to have a look at the Australia labour market itself, show you some numbers, and so we really get an understanding of what's going on, but where the starting points are and what to look for. We'll have a look at the reopening of the economy and what that means for the jobs market, and then of course the final piece is going to be around future of work, because I'll go more into that when I get to that. So the macroeconomy, why is it important? Or I suppose really what I should be saying is macroeconomic indicators. So a big part of what I want to achieve today is to share the sorts of where you should look, and the sorts of tips and tricks and clues and places to look for, to really let you know where to look for these clues, what they mean, what each of the different clues, where it's sort of what it's implying, and what the markets are currently implying for this kind of stuff. Because I think when you see Alan Kohler or whoever on the ABC News of a night, it might be a little bit confusing. So I'm going to try to break that down, and essentially, but why I've got this slide up here is the indicators that we're going to go over really indicate how the economy is growing, and what I suppose what the crowd thinks is going to be the path forward for the economy, and then of course how that flows through to the labour market. Another reason it's important is because it gives us clues as to business confidence. Again, this is very much a top-down basis, but essentially these economic indicators are really, if you know what to look for and you know what they're saying, they'll tell you what the business confidence means. And of course, at the end of the day, what that means is it's going to be implying a level of spending in the economy. And at the end, if you break down what hiring is, it's just simply an allocation of capital. So when businesses hire someone, they are willing to allocate whatever your salary is. I don't know, the average is what, 75 grand or something. They're going to allocate 75 grand for the next year in you as someone to, and that's going to show they want to get some sort of return on that, and they will only do that once they see spending, or alternatively once they see the signs that spending is about to come. So that's what we want to achieve today. So no PowerPoint presentation is complete without a silly meme, but at the end of this is exactly what's happening. There is some good news, but there's also some bad news too. And I'll go over the bad news first and hopefully bring it home with some better stuff that's going on. So what are the macroeconomic indicators that you need to look at? First of all, it's the bond market. The bond market is king. The bond market is going to be the most right, or should I say, it's going to be wrong less of the time than anything else. Commodities are a good place to look at, and there's lots of different commodities, and each one of them tells a different story. Currencies are good in the sense that they also tell a story, but a different story. And we'll go into actually a bit of Aussie dollar too, because that's been one of the big stories since the March lows. But also I call bullshit on stocks as an indicator too. I'll tell you why, but at the same time, there are some things that you need to take out of those. And so that's essentially what we're going to do today. And before I get into this, calling bullshit on myself in the sense that a lot of these are just screenshots. I don't have the access to make some pretty charts myself, but thanks to YouTube for essentially supplying some of these screenshots. But I do know what they're saying. So essentially, the bond market, what is it? Well, a bond market is basically at what price will you lend money to the government? That's the headline number, but what it means underneath that is really what's important. So what the bond market is essentially telling you is what's the level of growth in the economy going to be, and also what's the level of inflation. So inflation plus growth is essentially the bond yield. And what you're looking for here is, well, what this tells you is basically there's no growth whatsoever for the next 5 years. So in the sense that just the same way that you can fix your mortgage at different prices for different maturities, and I'm in no way suggesting you go and take out a mortgage or switch that, but I'm just using it as an example. If you see the difference between the 1 year rate and the 3 year rate, or the 2 year rate, the 5 year rate, whatever, the bond market also looks at that too. And so they call it the shape of the yield curve. And what that means is essentially they pay attention to the steepness. And so the story might go that if it's very steep, growth might be slow for a little while, but then in the future it's going to pick up. But the other thing that they see recently is if you see these three circled areas that dip below zero, what the bond market does is it also predicts when a recession is going to come. Now, over here on the right, we recently dipped below zero and we've got a recession. Now, any bond market person that says that that was an indicator is on drugs. What actually happened was the recession came out of a completely different reason. But all I'm trying to say here is that if you know what to look for in these areas, i.e., if we go back to just this kind of thing, if you see the bond yields go higher, that's a good sign. If they go lower and they even go below zero, really bad sign. So essentially it gets towards where growth is going to go. Steepness, again, the bond market pays attention to that. Oil. is another one. So rather than bond market, we're now having a look at the commodities markets. Commodities markets, again, is an indicator of growth. This part is, or gets towards the transport, basically. So how busy is transportation going to be? What that means, of course, is if we have to ship goods from one side of the country to another side of the country, or from China to Australia, or whatever it looks like. These are indicators of how busy it's going to be. You saw in April, things went really haywire there for a very low price, and there was a lot of press about that. But really what's happened here is it's come off, like the long-term price of this kind of stuff is $90 a barrel. We're currently at sort of, I can't even see on the right-hand side of my screen, but sort of somewhere between $30 and $40 a barrel. So it's indicating that it's not as bad as it was a couple of months ago. Still pretty bad. Copper is another one you want to look at. What copper essentially means is copper goes into electronics. So copper is in your iPhone, it's in your laptop computer, it's in all of this kind of stuff. And the reason they look at KOSPI, which is Korea, is because Korea makes a lot of this kind of stuff. So what you can do, again, we're trying to tie this back to the jobs market, local jobs market. If you are looking at a job in the industry, in the sorts of industries that create or that use copper and that create electronics, this might be a thing to look at as to when those industries are going to start rebounding. Good news is Australian dollar has been one of the poster childs for the recovery since the middle of March. So where our Aussie dollar was the first one to rally. And so every night when you actually do look at the Aussie dollar, pay attention, because it's going to tell you a lot about the global economy, a lot about when our economy is going to pick up. But I think what we are is almost a proxy for China. China being, of course, the growth engine through 2008, when the world blew up last time in 2008. It was a lot of China doing the heavy lifting, and so the world is looking to China, and they are reflecting that view, or the markets are reflecting that view through the Aussie dollar, which I think is, well, I don't know if it's good, bad or otherwise, but it does mean that our currency gets thrown around a little bit. But now when you see the Aussie dollar on the ABC News every night, there is a deeper meaning to what's going on. US equity markets. So I said to start with that the equity markets were bullshit as far as an economic indicator. The reason essentially is because, I mean, to me, that chart says the world is recovered back to normal. We are, I think last night it was about 3,100, 3,075 or something. This data is a little bit old, a couple of weeks old or a week old or something. Again, I'm just taking screenshots, so apologies for not having something completely up to date. But what you want to look at there is call a little bit of, or take that with a grain of salt. What's happening in equity markets is they're being dragged around by flows, which means essentially every dollar that you earn will go into your superannuation fund. Same in the States. Those flows have to go somewhere, and they push the stock market higher. It doesn't necessarily mean that the economy is better. And there's lots of different reasons for it, and that's a very much a topic for another time. But take it as I'll give you permission to call bullshit on the equity markets in general. This is Australia. I mean, if you have a look back here at the S&P, which is the US market, pretty much unchanged from the start of the year, like a little bit down, maybe 3 or 4, 5%, something like that. But not much changed, which is in massive contrast to what's going on in the real economy. Australia has not fared as well since the lows. For a number of different reasons. We don't have our central bank buying as much as they do, but again, for another time, that probably looks like about the right price to me. Please don't take this as investment advice. I'm not an investment advisor. I'm not a licensed advisor, but I do follow this a lot. So for me, my unprofessional opinion is it looks about the right price. But as I said, stocks are not a macro indicator for a number of reasons. The pundits on CNBC and Bloomberg and whoever else you look at they will all be saying that there's been a disconnect between Wall Street and Main Street, again, for a number of reasons. But to a certain extent, what's happened is we have a situation where, I mean, this might be a bit trite, but the world has been sort of locked inside for a long time now, and people get itchy, people want to do stuff, and they've found day trading as a replacement for sports betting. You've actually got this app called Robinhood in the US. We don't have it here. Robinhood is not here, but what it essentially is it's like the Robinhood is for 22-year-old bros what TikTok is for 12-year-old girls, kind of stuff. It's very much a gamey app that they can buy and sell stocks. But if you have a look at the copy down here, oops, I'll go back. Rich hedge fund managers are talking about it. So are not so rich millennials. Essentially, what's going on is there's getting a bit of a hype. There's getting a bit of an emotional attachment to the equity market, and so you can call a little bit bullshit there. But here's where it gets a bit more interesting. So the question is, why was COVID so damaging to the economy? Why have so many jobs been lost? I want to call out the difference between 2008 and 2020. In 2008, it was about this thing called a liquidity crisis. So businesses ran out of cash on a very short-term basis. They couldn't pay their salaries. They couldn't pay their whatever it was. And so they went bankrupt because they ran out of cash. So that is a stock of cash, as opposed to 2020, which they're calling a solvency crisis, or at least it starts out of a liquidity crisis, but it morphs into this thing called a solvency crisis. What that's all about is, rather than in 2008, your customers didn't go away. Your customers were still there. They didn't change their behaviours. Once this whole crisis had passed, there was no reason to think that customers wouldn't start buying again. In 2020, it's different, because what we've seen is, and that's what I'll go into a bit more, is the solvency crisis essentially says that your customers have changed and they might not be there when you open up. So think about things like the way that we work, the way that we interact, the way that we are willing to come together as a large group, the way that we want to travel together, the way that we want to, all of these things have fundamentally changed. Our behaviours, the consumer behaviours have changed. That then flows back through the system through to businesses, and we're calling it a solvency crisis. So what that means is, no matter how much cash we put on your balance sheet right now, you won't be in a position, unless you completely change your business model, you might not be in a position in the future to earn the sorts of revenue you need to pay back the debt you're taking on now. So it's a far more existential crisis. And over time, that liquidity crisis can morph into a solvency crisis. So there's a real urgency behind the scenes, which is why central banks and governments are pushing in so much cash to get the velocity of money going a lot faster, to avoid a liquidity crisis becoming a solvency crisis. I think this is probably my favourite all-time chart. Well, favourite, least favourite, I'm not sure which. So what it does is, and I know what you guys are going to be doing, is you're going to be looking for, you're going to say, okay, down the bottom there's a 2020 in a dark green, let's go and find dark green. I couldn't find the dark green until I took a step back. If each of you now looks in the bottom left-hand corner of that chart, it shows that's where 2020 is, and it shows you how far employment has fallen and how quickly it does. Now, bearing in mind this is US data, the reason I'm using US data here rather than Australian data or Kiwi data is because the data's there. I just don't have the amount of data that I can reach to for Aussie data. Plus, it's not as up to date. So I suppose the main message, main message here is, if you take one message out of today, what I want you to take is, for your job search and where you want to the industries you want to follow, or if you're in HR and you want to know if your industry if it's safe for your industry to start hiring again, follow the consumer. So what that means is a couple of things. First of all, how have the end buyers of your product, if you are, as example, I don't know, CBA, your end buyer will be the person who takes out that loan who actually goes and buys the house. So how have house buying changed? If you are David Jones and you are selling overcoats to people, I don't know, how has the behaviour of your consumer changed? And if you think that the consumer hasn't gone anywhere, they might have taken a rest from your product and they will be back again, you're okay, you're going to be okay. If you're in an industry where the consumers have fundamentally moved away from your product and they will not be back with your product for a long time, it's time to move on. Now, there's been a lot of talk about green shoots in May, and so again, try to tie this all back to the local jobs market. Apologies, this is US data, but that's all I had to go off. Green shoots in May, massive drop off in April as expected. I think also the March data was too high, but then we saw this big bounce back in May, and everyone's taking it as good signs. Yes, it's a good sign. Yes, it's the start of something. Does it continue? Well, what the really good part about the US data is that it goes very deep. And so you can tell from inside that data where people are spending their money. And so you have a look at things like home and garden centres, so the Bunnings equivalent, is looking pretty good. And I think, again, it goes back to that follow the consumer. Consumers are staying home and they want to spend money on their house because they've got time to do those DIY projects. So again, bring it back to the jobs market. If you are in an industry where your consumers are okay, where they're still buying your product, then you're going to be okay. Maybe wait it out. But restaurants and bars, so it tells a very, very different story. And again, this is US data, but it tells a very, very different story. So a big rebound in sales in May overall, but in terms of restaurants and bars, and this makes no surprise. But there's a long way to go back before we see the highs there. Auto sales, so pent-up demand. So again, if you are in an auto sales, I know our auto industry looks very, very different here in Australia versus in the States, but I'm just trying to make the case that for your industry, follow your consumer and pay attention to what they're doing. I do a lot of reading and watching. YouTube is an amazing resource. There's a bunch of stuff. So I've just listed down this kind of stuff. Feel free to take a screenshot if you want. Very, very broad mix of opinions and I suppose political leanings and all of this kind of stuff on this. I make sure I do that. Things like CNBC and Bloomberg, I suppose, fairly middle of the road. A couple of individual guys below that, Chamath and Anthony. Chamath's fully left-wing, Anthony's fully right-wing. Scott Galloway is just out angry at the world. Zero Hedge has a different bias. Zero Hedge is to financial press what I suppose the preppers are, the doomsday preppers are to. That's their take on the world. Telegraph has a lot of really good writers. I like Ambrose Evans Pritchard. He thinks the world's about to end all the time. Livewire Market's far more bullish, and local Aussie. Chris Joy is a guy that I follow a lot. Your favourite stockbroker will have their own opinion. So I suppose what I'm saying here is try to make sure if you are interested in all this kind of stuff, there's a lot out there. There's a lot for free, or there's a lot for, sometimes some of it you have to pay for, like I think Real Vision is a subscription thing. There's a lot out there, but beware of bias. Everyone has their own bias, whether it's a political left, right, or whether it's a world is in growth or world is coming to an end. And also calling bullshit on myself in the sense that I realise that there's no women in this list. I would love to know of some good female writers. So if anyone, writers or pundits on this, so if anyone has any, I'd love. I'm all ears. Now getting back to the local economy and where the local labour market is, essentially just as a sense of how big the numbers are. So this data again is slightly old, but you can say that the Australian labour force oscillates between, I suppose, 11.5 and 13.5 million. Previously would have been 13 to 13 a quarter, but is obviously down from the highs. Split between full-time and part-time work there. So let's say 1 to 2.5 is your ratio there. But really just to give you a sense of where the numbers are. Also to have a look at the unemployment rate itself. Be very careful of trying to compare unemployment rates because it's pushed around by how it gets calculated, and not every number is calculated equally. This participation rate at the bottom there, which basically says of every 100 people who are of working age, 63.5 are either in work or looking for work. A lot of this last few weeks or last few months has seen that participation rate go down, which does artificially depress the unemployment rate. So it's really hard. So essentially what I'm saying is the numbers are really hard to compare. So be very careful there. These numbers I got from ABC News the other night, or for a number of different places. There's 1 million jobs been lost to the end of May. Now these are numbers for Australia, and New Zealand numbers are about 20% of Australia's numbers as a general rule. 3.3 million people on JobKeeper. 7.1% was the unemployment rate in May. Again, that number is a bit spurious. If you include the jobseeker people, the number rises to 11. If you include JobKeeper, the number rises to 24. So I suppose 7.1 is the number we use, but there's a lot of holes in using that as a number. So it's difficult to compare apples for apples. Where have the jobs been lost? A lot of this is pretty self-explanatory and fairly obvious. There were some numbers that surprised me. I thought mining loss wouldn't have lost that many numbers. I saw also down here retail trade. I thought should have lost a lot more numbers than that. I'm getting that from Business Insider. I'm sure there are more timely numbers. This is the number of job ads. Basically, it's a Seek job ad series, but I think it's calculated by the ABS rather than by Seek itself. You can see that big 43% drop between March and May. Other numbers I've seen say that between April and May, they were up 60%. So essentially, take it that numbers are down lots. These are predictions from the different parts of government. So by the end of the year, Treasury is looking for an 8% number, and the RBA is looking for a 9% number, both of which are above where we are at least in May. Other things to look at. Other things to look at here, there are events that will affect things. So things like the coronavirus lockdown laws are coming to an end this week in New South Wales. All of these laws are a state-based item. Victoria looks like it might be heading back into lockdown, so keep an eye on that. Childcare, I think, free childcare will affect the jobs market when it rolls off. It was due to roll off in July, now it's been extended. JobKeeper, the drop dead date for that at the moment is 27th of September. They could change that. The mortgage repayment forbearance, that was done in March for about 6 months. Each bank is going to be different, so watch that. Rental eviction moratorium or early October. So people are talking about this cliff. They're calling it an economic cliff at the end of September, early October. Could be nasty. But NAB the other day came out and said that they thought that it was going to be a non-event. So who knows? Getting back to some of the predictions that I've made through this whole thing. So I came on a webinar early April and made some predictions. I'm going to try to keep time here too. Made some predictions about the sorts of areas that would do well versus the ones that weren't going to do so well. I didn't want to use the words winners and losers because no one wants to be seen as a winner from something like this, and certainly no one wants to be seen as a loser, but that's really just semantics. Some things I got right, some things I got horribly wrong. So big government, I think, is going to play out as a strong winner. Manufacturing will come back over time, will take a while. Healthcare I thought was going to do really well, but what happened was that they stopped elective surgery. So the industry itself, while it's been busy, they haven't been making any money. But that will normalise itself. Technology is fine. Insurance took a bit of a hit on their mark-to-market. but they're going to do fine overall. Education, I think, is playing out really nicely, other than universities, which a lot of which will be extinct at the end of this year if there is no government bailout. New energy and science probably take a while to play out, but I think that's going to come. On the challenged side, a lot of those are fairly obvious. Business travel, I think, is going to be challenged for a long time. I think what's going to happen is leisure travel is going to come back. We've all been cooped up. We want to go travelling, and we're going to somehow just muddle through the getting on a plane together. But I can't see that happening for business travel. Professional services, I got wrong. Professional services is doing really well. They planned for the worst, and I think they've come out quite well. Residential construction was another one that I got wrong with this recent home builder subsidy. Property will be challenged for a long time. Import-export is really a function of when they open the borders. Universities, as discussed. Public transport, I said, was going to be tough as an industry because I said who's going to want to get on a bus together. But at the same time, with the capacity being reduced, looks like the public transport might actually be hiring. And of course, the ones that I said were going to be ambiguous, which I could have seen good news and bad news stories for them. I think banks will muddle along. The housing market doesn't look like it's going to get destroyed, so they're going to go okay. And resources, the resource price index has rallied a little bit, so they're going to do okay. So I suppose that we've spoken about when all this kind of stuff opens up. I think it's going to be on an industry by industry basis. I think that the lockdown laws, it's going to be a function of the virus. I think it's going to be a function of when we come up with a vaccine. But the main message I want you guys to take out of today is follow the consumer. If you are looking for a job and you are looking to decide where to look for a job, follow the consumer. Where consumers are buying those products, that's who will be, those are the employers that either will be employing now or will be employing in the future. So target your job search there. The other piece, which I didn't discuss last time, follow the capital raises. So what that means is a lot of companies who had a not so strong balance sheet have had to recapitalise their balance sheets. The ones that have done so early will be the stronger employers coming out of this kind of stuff. Shareholders hate them, but for the sake of the business, for the sake of the employees, and for the sake of their ongoing nature of the business, I would suggest that when you are choosing the employers to look for, the ones that have done a capital raise are a much safer bet than those who haven't. Okay, going through the good news now, with a heading, it's not all bad news. Yesterday, Australia was upgraded. I think we were the only OECD country to be upgraded by the IMF. Still off a very low base. It's still not sort of party time yet at all, but it's a whole lot better than others. I saw this a couple of weeks ago on LinkedIn, and I absolutely love what he says, not but because of why he's saying it, but essentially what it means behind the fact. So Tim Fung is a guy who owns a business called Airtasker. Probably some of you have used it. Think about it like a freelancer kind of stuff for tradies. If Airtasker is hiring inside their own business, it means that lots of traders are getting lots of work. And this, of course, was before the house builder home subsidy type stuff. So I think that only continues. Ayman is a Kiwi. Of course, if and when we can eradicate the virus from Australia, and I know that New Zealand has had a lot of success there, once we can do that, the economy will jump a lot. So keep an eye out for that. Tourism, as I said, tourism is going to do okay, I think, long term. Business travel is a bit stuffed, but tourism will do well. And if you've got businesses like Qantas and Jetstar pushing it, I also note that Qantas has done a big capital raise yesterday, so they've got the firepower to do this. There's a lot of engines that are going to be pushing the tourism industry. It's in everyone's interests. Australian businesses are hiring again. Now, be very careful of numbers like this. Advertised jobs jumped 60%, sounds really good, but if it jumps off a very low base, it's still a low number. So I reckon in April, between sort of the start of this to about April, I reckon the job ads dropped about 75%. So they're now down at 20%. Jumping 60% of that gets you up to about 45% or 40%, or whatever the number is, gets you actually back up to 40% of the full capacity. So yes, it's an improvement, but it's off a very low base. And the last piece I wanted to chat about, or one of the last pieces, is how the new ways that we are working is going to affect the housing market. Again, not that I'm suggesting you go out and buy yourself a house or anything, but I think it'll change the way that housing market does. One of the pieces of data we've got inside FlexCareers is that fully remote working roles that are fully remote were previously in 18% of businesses, will be in 68% of businesses. This is going to affect how we want to live, because if you are working 100% remote, your commute means nothing. So I reckon this is just a really rough map of Sydney using my best PowerPoint. But what I've done here is the really tight ring around Sydney CBD. I think those houses are going to be unaffected. The commuter belt around that, so between say 10 kilometres and 40 kilometres out from the CBD, I think those houses get sold. I think those prices are significantly lower. And I think what we're going to find is the people in that commuter belt will move out. So they'll say, why am I in a $1.2 million house in Parramatta when I could move out to Windsor, have a bigger house and a much smaller mortgage? So final thoughts. I promised future work. I don't have time to get onto that kind of stuff. Which jobs are going to disappear will be for another webinar. Which jobs are going to disappear are also, the other flip side of that is which jobs are going to take their place. We are in the great labour reallocation of 2020. So I think the future work, it has a big part to play in this. The final piece is taxation. I think we're going to have higher taxation on personal. I think we're going to have higher taxation on government, on corporate, because somehow we're going to have to pay for this. So that's it for what I've prepared. I would very much encourage people to put questions up now if you've got any. I'd love to answer them, and I can also already see quite a few there. If you want to reach out to me, please do so. I'd love to hear from you guys, and if there's anything that I can do to help. I'm just going to hit if I can see the questions, because I can see there are questions. Oh, okay, geez, we've got a lot of. Okay. All right, I'm going to try to go through these one by one. When will job approximate time to regrow and everyone get work? When is the jobs market going to be back to normal? We did a poll about 4 weeks ago where we asked people, how long do you think it will take for the jobs market to normalise? The average answer was 16 months. If you have a look at the 2008 experience, again, I got the data from the US. The lows were in September of 2008, and the jobs market started net adding jobs in November the following year. But then at the same time, this is a much different experience to that. Do you know which sector or parts of the economy have seen growth recently? Again, I would suggest you look at the consumer. Where are people going to? What are people buying? So they're buying stuff online is one big thing. They are so online means logistics need to go better. It means also that technology has to go better. It means investment in that kind of stuff. So if you have those sorts of skills, go for the technology jobs. If you don't have those sorts of skills, have a look at there's a lot of businesses out there that are a lot of technology education businesses. So I called out Google General Assembly. I also called out Academy XI as, they're fairly expensive to get diploma level stuff, but it's really detailed and deep and will get you a job. So I think they're anywhere between $5,000 and $20,000 or something. There's a bunch of free stuff or low cost, no cost type stuff. Udemy is a good one to look at. Khan Academy does a lot of the basics. Okay, next question. Can I please explain the term capital raise? So essentially, businesses like to have a certain amount of capital money. Think about it like money. They go out to the market and they sell new shares to raise money. What that means is they are a much safer bet. They're insulated if things keep going bad. So I suppose I hope that answers the question. Do I think things will differ evenly from state to state? State to state is very much going to be a case-by-case basis. Probably New South Wales has fared best. Victoria has fared the worst, and that's really as a function of how the virus is playing out. Watch the numbers in Victoria. Watch the lockdowns. The lockdown laws will slow things down. What are the prospects for non-residents under these? Sorry, I'm going to expand this. Under these temporary circumstances. I'm not an expert, sorry. I would suggest that in times like these, when businesses need to hire quickly, I think they'll take the path of least resistance, which is hiring the local, but that's just a guess. I don't know. In difficult times, won't NGOs be experiencing need to reduce headcounts, i.e. headcount versus recruit? Yes, normally you'd expect so. I note that the federal government has put quite a lot of money recently into some of the areas. So I know that mental health was a big area that they invested money into. So yeah, I suppose I'm not sure if that's a great answer, but next question is, good afternoon. How about universities after this year? It seems that it would be changed after students find they can learn online and professors can teach online and even conferences can be held online. That's absolutely correct. I would also say, though, that part of the value proposition of going to university is all of the intangibles, like the getting to meet networks, getting to just experience university life. And are people going to be willing to pay a full fee university, or not even pay HECS, sign up for the same price that they were signing up last year when they can't go out and experience that, when they can also get much cheaper versions online? I think universities are going to be troubled for a long time. I know one of the stronger universities, Macquarie University, they came out the other day and said they had been planning for the worst for a long time. In terms of looking at universities, the one piece of data to look at is the reliance they have on offshore students. And then, of course, the sooner that borders open, the sooner those students can come back, and the sooner it will be all back to normal on a cash flow basis for the universities. That's about it. If anyone's got any more questions, I would love to hear about them. I think what we've got, though, is I don't want to take up any more of anyone's time. So I'll say, actually, for now, thanks very much. Thank you very much for coming along. There's a lot of you that came, and I really, really appreciate it. Here at CareerSwitch and here at FlexCareers, and also for our friends at Moi. It's really important for us to be able to share this kind of information with you, because essentially this is a lot about how we help our people going through outplacement, how we help them find a job. So I hope you guys got something out of it. Thank you very much for being with us. And yeah, see you online next time. Any questions, come through to me. My details are on the screen. So thanks, guys. Bye.